Well, let's stick with the economy now and the pressure on interest rates to rise. It's coming from overseas, especially the US, which raised its official rate by 0.75% overnight, with the same likely next month as well.
Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. We will, however, make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as we can.
Well, here the economic story is all about the employment numbers. Unemployment is steady at 3.9%. But look, there does seem to be a change in behaviour by both business and workers here. First, the proportion of people in work is at an all-time high. And in May, full-time employment jumped by 69,400 people, while part-time employment dropped by 8,700. Now, this seems odd, especially with all the part-time work that was created for the federal election. So let's bring in here Sean Langcake, who is economist with BIS Oxford Economics. I apologise. Sean, many thanks for your time. Just on that issue of the employment numbers, look, it's steady. It's still at 48-year lows, all that sort of stuff. Is there any pressure building up that you can see in the employment markets right now?
I think the pressure comes from the fact that we're getting really close to the economy or the labour market being at full capacity. So the capacity for firms to either add new workers or get their existing workers to work more hours is becoming really constrained. We've got the unemployment rate obviously at a very low level, but really the big takeaway from today's numbers was the underemployment rate really taking a fall to a record low level. Okay, so underemployment, so business needs more workers. Workers are now becoming concerned about the cost of living and interest rates. So you could see that there was a move to full-time work. You can see what's happening here. The workers realise they need stability and security. The employers say, well, to keep these workers, we can't have them as part-timers. We're going to move them into full-time work. That seems to me to be the dynamic in the labour force. I think that's fair. Every indicator we have of labour demand, the workers or the labour that firms want is at record high levels. So job vacancies, job ads, it's all kind of through the roof. So they want workers, they would ideally work with their incumbent workforce and increase hours. Where that can't happen, you need to look to bring more people in. So I heard the employment minister today basically saying, well, we haven't seen the wages growth. At what point does the wages growth come through? Because as he says, it should have already come through, but it hasn't. So what's happened there? It's a slow-moving process, really. So what we saw in the first quarter of the year was the average increase where people did have their wages changed was 3.4%. Now, that would be a really strong number if we started to see that across the whole economy. So I think it's starting to come through. As we get into Q2, Q3, where more people have their wages reset, we can be relatively confident that it's going to come to bear. OK, but then there's another fundamental issue that happens inside business. At some point, if you push up the wage prices too high, eventually you're going to see that profitability drops, in which case then they start to look at, well, how many workers do we actually need here? That is going to be another key as we move forward, isn't it? Yeah, we could definitely see pressure on margins or prices increase. And that's where we get inflation from. Right, so you get inflation, you get interest rates, and then there's the danger, of course, that if somebody loses a job, then it's harder to actually maintain that mortgage. If they have to sell, house prices start to fall. That's the ratcheting on of the slowing of the economy. 100%. I mean, where households get into financial stress is where they lose their jobs. Now, that's a really strong tailwind that we have in the economy at present, is that the labour market is in a really healthy state. So in the aggregate, we're seeing less of that across the board, which is a really strong thing. So the really interesting part about this is how high do interest rates have to go before they start to pinch, the employer to actually lay off people, which therefore pinches the housing market, which therefore pinches the household spending. So all of these things are related, and even the energy prices right now, sort of that plays into this whole thing about the stresses under which the economy is going to be under. It's not right now, maybe not even in 6 months' time, but certainly into next year it comes. I think that's fair. I think, what we've seen from the Reserve Bank is that they were keen to keep interest rates as low as possible to make sure that this recovery kind of took root and was underway in the labour market. They're convinced that's the case now. They're hearing that from their business liaison program, and we're seeing it in some of the data where the labour market's nearing capacity. With that kind of entrenched and in place now, they're willing to walk away from having rates at emergency low levels. We saw in May and then in June even more so, they're going to get away from those levels fairly quickly. Another big rate rise coming in July, we expect, on the back of today's data. The question is, what do they think is that level where they can kind of say, all right, it's time to pause and read the data now and manage demand a little bit?
So, okay, so where is that number? In your head, where is the peak of the cash rate before the RBA stops?
I think probably around 2.5%. That's what I'd consider to be roughly.
So not where the market says, which is 3.5% somewhere.
That's right. Yeah, that's quite bullish. To get to that level would be an incredible shock to put through the household sector right now. And I'm not convinced that the RBA is ready to quite go there.
I'll tell you what, Sean Langcake, many thanks for your time today from BIS Oxford Economics.